So exercise 7.1a is basically an exercise to take a series of entries and classify them whether they're general ledger, sales journal, purchases journal, cash receipts journal, or cash payments journal, and then as a secondary element to show whether or not they have an accounts receivable subsidiary ledger reference or an accounts payable subsidiary ledger reference. So I'm going to go through the first few together with you just to show you how the solutions work out. And then I'll leave the rest for you to figure on your own with the responses that are there. So in July 2nd, they've issued an invoice number 913 for sale on account to Taranashi Incorporated for $12,300. And Macmillan's cost of this inventory was $5,400. So our concern right now is less about the accounting entries and more about which journal we need to deal with this particular client. And what we learned from this is that the sales on account, so the sales being made on account means that the sale is not being done in cash, which means we're going to create an accounts receivable. So therefore, the response to this would be sales journal, or an S, and accounts receivable subsidiary ledger. Because again, we're creating a sale on account, as indicated here, and since it's on account, we won't be collecting the cash, therefore we need to create an accounts receivable subledger on it. So that's how the first one looks. So let's look at the next grouping. So let's take a look at the July 3rd transaction. So on July 3rd, they purchase inventory on credit terms. So they're purchasing. So that's going to get us down here either into cash payments or purchases. And they're doing it on credit terms, which means they're purchasing it using an accounts payable with this company. So if that's the scenario, what we have in July 3rd is it's going to be purchases journal, again non-cash, and accounts payable subledger because it's on credit terms. We move to July 5th. We sold inventory for cash. So if we're selling and it's for cash, it's going to be coming from our cash receipts journal. So it's going to be cash receipts, and there's no subsidiary ledger applicable. So in this case, I've put non-applicable, just so that's clear. The next transaction on the 5th of July also is they issued a check number 532 to purchase equipment or furniture, for cash at $6,555. So again, it's a check issued, but they're purchasing cash with cash. So effectively it's going to be a cash transaction. So in that case, it's going to be a cash payments journal entry. And again, no accounts payable is being created or used, so therefore that journal entry is not required. That ledger entry is not required, so again, not applicable. Move into July the 8th, and then we collected interest revenue of $3,325. So we've collected revenue, and it's in the form of cash. So effectively what we have is a cash receipts journal, and there's going to be no subsidiary ledger involved. Moving to the 9th, we issued another check for sale on account to Bell. And that sale was for certain dollars, which is not particularly of importance. So what's happened is we've issued an invoice number for sale on account to Bell. So issued an invoice for sale on account to Bell. So it's going to be a sale on account, which means it's going to be a sales and accounts receivable, sales journal and accounts receivable subsidiary ledger. And then on D, they purchased inventory for cash for $3,429, issuing a check, but again, it's purchase and it's cash. So it's going to be your cash payments journal. Hopefully that makes some sense. If you use a critical path from the prior set of slides as your key to making these decisions, you'll find that it's a little bit easier running through these. When we look at the next grouping, what I've done is provided you with the responses over here. Take note that there are certain situations, such as cash receipts, where there is an accounts receivable subledger impact. And the reason that's happening is you received the cash for a sale, but that cash is from a sale that has already been recorded through accounts receivable. So your cash receipts are your journal entry, cash coming in, and your adjusting entry is going to be on the ledger side, which is reducing the accounts receivable that was in place. Similarly, in 13, we've got an issuing of a check to pay a corporation, one of our suppliers, the net amount owed from July 3rd. So because it's money owed from a prior date, it must be set up as an account payable. So again, it's going to be cash payment at that point, but there's a subsidiary ledger impact on the accounts payable. So again, thinking of all the impacts as we move forward. And the key in this one is the date difference. Okay, so the rest of these, if you follow through the similar logic, you'll be able to check your answers. If you have any particular issues with this, of course, feel free to reach out and contact me for clarification.